Well, good morning, everyone. Welcome to Trading a Smaller Account, or maybe good afternoon, because Eastern Time, this is high noon. Today, we are going to talk about the rules that we follow and the rules where we might have a little bit of wiggle room. We're going to talk about trades that take advantage of stocks moving sideways. We're going to take a look at bullish trades and bearish trades. So we are going to be all over the map today, but our goal in this account this year was to make $100 a week. We started the year with 25,000. We're kind of, I think, ahead of the game so far. I don't know how many weeks into the year we are. But this is our goal. And sometimes when we're looking at trades where we're making a modest return, we might not think it's all that in a bag of chips. But if we keep in mind our goal of earning on average $100 a week on our $25,000 account, it helps us put our trades in perspective. So I want to thank each and every one of you who continue to show up with me live. I know that thousands of you watch this in the archives, and I applaud you for taking time out of your busy schedule to tune in even after the fact. But for Priya and Rob and Debbie and Carter and Bill and Greg and Life in the Fast Lane, some of these names are so great. And Sharon and Dominique and Tammy and Unexpected Good Luck, which I am still waiting for this week, but the week is young. And the rest of the gang, thank you all for helping bring this class to life by being so participatory in the chat. Sharon's asking if I can talk about the MCHP trade, and you're in luck. It is on my list to discuss today, so we will be looking at that. We have the privilege of having Mr. Ben Watson in the chat with us today. You won't get to hear the dulcet tones of Mr. Watson as he is silenced in the chat, but he understands all these strategies inside and out that we're going to be talking about today. So if you have any questions, don't hesitate to ask. Also, make sure you're following Ben and I in the land of X, my handle at Barb Armstrong CS, and Ben is at Ben Watson CS. We're also now active in the land of LinkedIn. So if you aren't following us on LinkedIn, head over to LinkedIn and have a look for us. You will find us there also. So I have a whole list of things that we want to cover today. So let's get down to it. Keep in mind, we do a lot of option trades in this class and know that options carry a high level of risk and aren't suitable for all investors. You also have to apply for option trading privileges with Schwab. Not all will qualify. We use the paper money software application on the thinkorswim desktop platform. It is a brilliant place to learn and hone your skills. Know there are some nuances and differences. One is that short option positions will never be assigned early. We're going to talk a little bit about that today, that possibility. So here we go. For a market overview, I now do like a super compressed market overview because Kevin Horner, 4 days a week, does a fantastic market overview at the market open called Trader Talks. There was one this morning. If you missed it, you may want to go back and catch that in the archives. We're going to place a bunch of new example trades today. We're going to do some, we're going to do a variety of things. And I don't know if we'll get to all of them, but an iron condor is on the menu, a short put vertical, a long call vertical, maybe a long call. And then we're going to do a little trade management. So we'll kind of go back and forth in between. Okay. And actually, we started with 25,000, not 20,000 this year. Position size, if we're doing a buy right covered call or buying shares of stock, is 5,000. And you may say, hey, back the truck up. And my drawing tool is not yet back with me. And so I feel slightly handicapped here. But that's 20% of a $25,000 account. Now, if you had $1 million account, you might not put 20%. You might say, I don't want to put more than 5% in any one account. But this gives us the capability of buying shares of stock and of, if the stock is $50 or less, potentially doing a buy right. We have a couple of those on. Our max trade risk is 500 per trade. And our focus is on the short to intermediate term time frame. We're not doing a lot of longer term buy and hold. So Bill, it would be 25% if this is 20,000, but it's actually 25,000. And I don't have my drawing tool. I'll correct that before the next class. Okay. And we look at both bullish strategies, which can include all of these, and bearish strategies as well. So we might do a long put or a long put vertical. We did a couple of long puts on Friday. We've done short call verticals this year. And then we're going to look at an iron condor strategy today. Okay, so let's start, with just a super quick look at, where we are. So we're at 30,766. At one time we were, at almost 32,000. So we've taken a couple of knocks, but given we started at 25,000, that kind of return isn't too shabby. So, if we, our goal was to make $100 a week to $200 a week, we're well ahead of schedule. Okay. Because that would be, $5,200 on the year. And so we've already done that. But this is a paper money account. Sometimes we get paper money fills. These are example trades. I don't think commissions come out of a paper money account. So, there are some nuances and some differences. So let's start talking about iron condors. So we did an iron condor trade on NVIDIA, and we did one because volatility was high, and our thought process there was, hey, we've got really high volatility on a stock that tends to carry higher volatility. Could we do a trade that's only 2 weeks in duration and do an iron condor? And that day, my system was kind of acting up. So we put it in as a short call vertical and a short put vertical, which is actually what an iron condor is. It's a credit spread sandwich is how I like to describe it. And so this Friday, this expires, but because volatilities continue to be high, we want to get out when we've got 80% of our max gain, and we're not quite there yet. So, but it's still sitting comfortably in between, we want it to stay below 195 and above 170. And so it's still comfortably kind of rolling along. But if it doesn't, close itself out, because we have targets to close out the short put vertical when we have 80% of our max gain and 80% of our max gain on the short call vertical, you can see here that, we want to get out when this is worth 9 cents. It's currently at 16. And 44 cents, we want to get out when this is worth about 9 cents. And, it's at 26. And so we can see here when we go to NVIDIA, we've got our targets in place. We're just not quite there yet. But there's nothing that is currently saying, hey, we should be worried. And so we're going to let this percolate. So that's the trade we put on March 6th. Now on Friday, we decided to add another trade. And so we did another iron condor, which is in just 2 weeks out. And so this one expires on March 27th. And we have a very modest gain on this one. Okay. So that's where we are on NVIDIA. Now I said, could we perhaps do another iron condor trade? We're not going to do NVIDIA because we just put an iron condor on NVIDIA. But here's a stock that since the middle of December, AVGO Broadcom has been trading between kind of this 308-ish and 355-ish, maybe I'll just make this 355 range. And could we do something short term? And we have to check on some things, because one of our guidelines is we want the stock to be heavily traded. We want there to be volume on the options. So, and it's trading kind of in the middle of this range right now. So could we come to the trade tab, and could we come out to say this April 10th or April 17th? Now, if we look at the 17th, what's the problem? Our monthly options. We've got tons of volume, like thousands of contracts. So that's a cool thing. It's already traded over 10 million shares. So check there. That meets our requirement. But what's the challenge? The challenge is that these are $10 wide. So if, and I did look at this ahead, we'd get about, if we did the 300 and the 290, because I always like to see, like, is both sides making a contribution? If we get about $2 for that, and if we come up to the 360, we wanted it to be above 355, we'd get about $2 for that. So in total, we get $4. That means we're risking how much? We're risking 6. So 600. Is 600 higher than 500? Yeah. You know, and it's just a little too much higher. If it was like maybe 550, we might say, okay, we'll go for it. You know, give ourselves a bit of wiggle room given we're up on the year. But this is just a little, just a teensy bit out of our snack bracket, but it's still risking more than we want to risk. So if we come to the weeklies, this is 25 days out, which means time decay is hopefully going to be kicking in a little faster. And could we come out to the 305? You know, we've got, you know, a reasonable bid-ask spread. We have 139 contracts, so we're okay there. And will we get enough juice for that to be worth the squeeze? So we get $1.15. Like that, even on its own as a short put vertical, would be over a 25% return on our risk. And our guideline on a vertical is that we want to get at least 1% for every day to expiration, just as a way of creating an apples to apples type comparison. And if we come up to the 355, we get the same thing, you know, over $1. So if we want to put this in as an iron condor, we'd come up here to sell. And so you can do this either way. So somebody said, are you best to put it in as an iron condor or as a, you know, or as a 2 credit spreads? If you put it in as 2 credit spreads, it makes it easier to put in the legs, exits on each individual leg. So we wanted the 305 and the 300. And then on the top end, we wanted the 360. So I'm going to come here and make that 360 and make this 355. Now, how much are we risking? Well, if you don't like to do the math, you can just hit how much are we risking? Well, if you don't like to do the math, you can just hit confirm and send. We're risking 270 to potentially make 230. And so if we look at that and say, well, you know, that smells like almost 100%. So I'm going to come here, actually, say, okay, I can potentially make 230. Say, okay, I can potentially make 230, and that means I'm risking 270. So my potential return on risk is 85%. So that meets our criteria. And so we're going to take our single order. Oh, it's not letting me download this. In our iron condor group. And then once this order is in, we can put in exits on each side, or we can just put in one exit and say, hey, when we've got 80% of our max gain on this trade in total, let's exit the position. You know, and you might say, well, I want to exit when it's 90%, or someone might say, I want to let it expire worthless. You know, we don't, that isn't part of our rule set with a credit spread. We, with a credit spread, we exit prior to expiration. Okay, so we've gone ahead, we've teed that one up. Oh, and you know what? Actually, we did one contract because we were risking, but you know what? Let's cancel and replace this because we could do 2. Because if we're risking 270, we could actually do 2 of these. Oh, now it's saying it only wants to pay us 240. So we're going to say, okay, fire in the hole. Okay, so we'll let that percolate. So we've reviewed our 2 iron condors on NVIDIA, and we've placed an iron condor trade on AVGO. And our strikes are at 355 and then 305. And if you want to show that on the chart, I'm just going to make this 305. And this is an iron condor, and it expires April 12th, or April 10th. And we'll show that on the right. And then this is 355, our iron condor, April 10th. So there's a question saying, are we always going to sell the strikes closest to the money to receive the highest? This isn't closest to the money necessarily. We are selling a strike on the call side above where we believe the stock will go. So we believe it's going to stay below 355 from now until April 10th. And we believe it will stay above 305 from now until April 10th. That's our analysis in looking at the charts, is that it will stay above these. Okay? Okay. Now, let's go and look. The next thing on the list was buy right covered calls. So we have 2 buy right covered calls on where we've bought 100 shares of stock and we've sold a covered call with the goal of being called out. Now with KMI, we sold that call for 44 cents. It's now worth 2 cents. So we've got pretty much our max gain out of that. So let's look at KMI. So on this day here, we bought 100 shares of stock, and we looked at this and said, this has really been uptrending nicely, but this candle is indicating that it may pull back. And in fact, it did. So we sold this call saying, hey, if it keeps on going, we're happy to sell it at 35. But it has pulled back. And so if we look at where our stop is on this, on KMI, let me just, sorry, come over here for a sec. I'm going to bring up our order. Our stop on KMI was at 31.82. 31.82. And so what we might choose to do, because it's sitting closer to a support level, is just buy back that call that we sold. So I'm going to exit. I'm going to just cancel this order because I can't buy back the call if there's an exit already in place. So with KMI, we're going to come in and say, okay, I would like to close this out, just the call part. Yeah, if you want me to pay 4 cents, I'm feeling generous. So we put in an order to buy back that call. And then once that fills, I'll go back in and add the stop back in. Okay, so now I can go in and add the stop back in. And our stop was at 31.82. We aren't going to close. We aren't going to change that. 31.82. Now, could I go in and sell another call? Well, I sure could. And volatility in the market is still relatively high. But if I look at this and I say I could sell the April call for 41 to 45 cents, But if I wait until it gets closer, like if I'm still bullish on this stock, maybe I want to wait for a couple of days in the expectation that the stock will rally and sell the call for more. So we're going to leave it in our buy right covered call bucket, and we'll look at this again Friday. Now, there's also the chance that it could come down and hit our stop, and if we had sold this, that might offset some of what we might lose on the stock position. But if we're bullish on energy in general, and this has been kind of consolidating, if we're continuing to own the stock, then the expectation might be that it will go back up. So that's what we're going to do with that one. Now, Devon, we're in the money. Are we in the money by a mile? No, we're not in the money by that much. We're at 40. We sold the 46 call, and actually now it's at 46.68. So let's go and look at this. Now, when we just look at the math, we sold the 46 call, which means the most that we can get on this trade is $46. We're at $45.42. So we're up $148.50, 3.4% on the total position, including the value of the stock. So we're up 149. We could make another, we're at 45.43. We could make another $50 or so, which is, 25% more, 148 to 150. So we could leave it, or, we could roll this out. So let's come and look. So when I looked at this first thing this morning, we had, a doji pattern, and now it's moving up. So could we maybe roll this up to maybe the April expiration and maybe roll it up to 48? We could do that. Well, let's see. Like, would we get much of a premium? So if we look at where we are now with the March, this is $1.16 to $1.35. If I come out to April, I might get a little bit of a credit, not a ton, but then when I sell the stock, I could get $2 more, which is not nothing. That's $200. So let's come to Devon and say, okay, I'm going to have to, exit. I'm going to have to cancel that order on Devon. So we're going to come and cancel that exit, because I'm basically buying back the original call, and we're going to sell a new one. That's what rolling is. So I'm creating a rolling order, and what it will do automatically is say, hey, this one originally expired March 20th. We're going to go out to the next closest expiration date, but let's say we want to come all the way out to April, and we're going to make this the 48 call. Oh, it's saying it's not traded. So it may be just $5 wide spreads until we get past Friday. So I might have to go with the 47.50, but then, I might get a higher premium. So let's see if we can do that 47.50. Oh, sorry. This was 46. This is the 47.50. So that would give me $1.50 more and a 61-cent credit. And if we're called out, are we going to be sad? Well, no, because we weren't going to be sad if we got called out at 46. And we're getting paid 61 cents to, be in this trade for another 32 days. And another potentially 150. Now the stock could go down. Now we could go to April 10th. So let's see, April 10th, then we could go to the 48. Let's see how much of a credit we'd get. only 17 cents. So we get a little bit more in total if we went for the 47.50 and went out one more week, but then we're in the trade potentially 1 week longer. But we've got a lot more volume on the monthly contracts. Okay, so CB A82, thank you for, bringing that up. So we're going to roll this. Okay, confirm and send. Send. Okay, so that is our buy right covered calls. Let's go out and look at something new. So, we'll look at the new, and then we'll look at, with short put verticals, I want to look at one new. We've got some trade management, and we have one that hit our target today. So we've got 3 ways to, to look at short put verticals today. And a short put vertical, I say, is a kind of sort of bullish strategy. And what do I mean by that? Well, here's another stock that's been trading in a range. So you may say, hey, range bound, shouldn't we do an iron condor? Might that not be a possibility? Well, it might, but it's sitting down at a support level. So could we maybe go out to the April monthlies? And if this comes back up here and starts to roll over, could we add in a short call vertical and turn it into an iron condor? So could we leg into an iron condor? And the answer is, it's our trading strategy. We can do whatever we want. So, and it's bouncing off this support level, and it's come down, into this neighborhood of support once, twice, 3 times a lady, 4, 5, 6, 7, 8 times, 9, 10-ish times. Like, not saying that just because it's come into this neighborhood of support, is it going to hold? But it appears to be holding so far. And then when we come in and look kind of up close and personal, this pattern so far today, and it could change by the end of the day, looks like a bit of a harami pattern or an inside day, which is considered bullish and does not require confirmation. So let's come out to April. And the reason we're coming out to the monthlies, like 32 days instead of this 17 or 21, is because we're thinking we might have an opportunity to leg into an iron condor. So, does this trade more than 1 million shares a day? Check. Is it bouncing off a support level? Check. Is there a tight bid-ask spread? Check. Do we have tons of volume? Check, check. Now, the next question that we need to check for is, are we getting enough juice for it to be worth the squeeze? Well, that looks like a check to me, because $5 minus $1.67, I think that's $3.33. If my math skills are serving me, which, may be right, may not. But that's about a 50% potential return. If I come to confirm and send, it'll do the math. So 167 divided by 333, that's 50%. And our rule is, when we look at our trading plan, we want it to be at least 32. So it's more than that. So, but if we're risking 333, can we do 2 contracts? No, because that would be 666. That's out of our snack bracket. And once again, this isn't coming up for me. So we're going to go ahead and put this in our short put vertical bucket. And then I don't usually demonstrate this, but necessity is the mother of invention. Once this fills, we can go in and put in our exit. Because what I really like is you can be out walking your dog or golfing or skiing or lamenting the fact that I have spring weather here in Utah, and, we haven't had much of a ski season. But yeah, so we can add our exit later, and that would be at 20%. When we've got 80% of our max gain, we would like to exit. So we'll just give this a few minutes to percolate. So that's AMD, and I'll make sure that these fill by the end. Now, we also had a short put vertical on Coca-Cola. So on this day here, on March 9th, we did 2 trades. We bought $5,000 worth of stock, and here's our target. So it was kind of a swing target trade. And then we also did a short put vertical with a $1 wide spread, and that expires Friday. And today that hit our target. So if we come to the monitor tab and we look at Coke, so here are the 2 trades we put on the 9th of March. We got a 25-cent credit, which doesn't seem like much, but we put this on the 9th of March. It was only a 2-week trade. So we were trying to take advantage of volatility and do a very, like a shorter than usual term for a short put vertical. It was only 2 weeks, but we got out of that today. So we made 20 cents per contract, and we did 6 contracts. So we made $120 on that. So there's our goal for the week, and it's Monday morning. So yay us. Now you have to take transaction fees into account, and with a vertical, it's $1.30 per contract. So times 6, 1 to get in, and then if it's a nickel or less, there isn't a transaction fee to get out. But that would have been, you know, $1.30 times 6. It would have cost us, had there been transaction fees, $7.80 would have come against that 120. Okay. Okay. So that was Coca-Cola, and our return on risk, if we wanted to calculate that, we netted 20, and we would divide that by the 75 cents a contract we were risking. It was a 26.7% return on risk. Now we have short put verticals on Caterpillar and Apple, which, you know, have been causing some angst. And because these are now expiring Friday and they're both in the money. Okay, which, you know, is not where we want to be. So let's look at them. And we talked about these briefly on Friday. So we put the trade on here, and, you know, it stayed largely above until Friday, and then it came down. Now, so right now it's at 252. It's sitting in between the strikes. And this is a really dangerous position to be in were it at expiration, but we have a few days. Okay, so, and this is a Harami pattern, which is indicating that it may have, you know, found a support level and be bouncing. So we're going to watch this for the next couple of days. But if it looks like it's going down again, we definitely close it out. Okay. And we definitely will not let this go into expiration. We meet again for this class on Friday morning. So worst case is on Friday, we close it out, but that's Apple. Now, Caterpillar doesn't look quite so sexy. We are through both strikes, 740, 735. We're at 690, 688. So we're up almost $3 today. But you know what makes me nervous when I look at this is that it opened higher, and it's still like $2.69 above where it closed Friday. But, and this is still a live candle, it can change by the end of the day, but it opened higher and has been pulling back. And so, and the closer you get to expiration, if it were in a live account, you know, the higher, you know, the likelihood that you could be assigned. And, you know, we have a $30,000 account, and we did a short put vertical at 740, which means that's if we were assigned, it's a $74,000 position. So if we were assigned, you know, and it's assigned kind of in a lottery, if you will, you know, this, if we were assigned, then what might we do? Well, we go to our 735, this strike that we bought, and we'd say, okay, we are going to exercise our right to sell at 735, and we'd have our max loss. So on this one, and I like to run like a semi-democratic class, we're at 450. So our max loss would be $5. And it could continue to go up for the next few days, but I'm going to put a little poll in and say, do we take our loss on cat today? Do we close it out? Should we close it out and recognize the loss? It's because, we're locking in that loss. And the question, it has to be in a binary way. So it's a yes or no. So, do we, suck it up and take the loss? We could lose another $48 on this. So we're, by recognizing and putting this into our official loss category, we're recognizing that loss, but we're preventing ourselves from losing $45 more. Or we could say, hey, we're up by $2.45. It could continue to move up and we might lose less. Or, in an average day, this stock can move 26 bucks. If it moved up, the next couple of days, we could end up not losing anything at all. Okay, so go ahead and vote, and I will go with whatever the majority says. 82% are currently saying take the loss. And then, on the upside, we're preventing ourselves from losing that other $25. Now, on McDonald's, somebody asked me to look at Mickey D's. This one also expires Friday. We are above both strikes. So how on earth is that working? Now we're above both strikes and we're losing money. Like, we're not losing very much. We're down 15 bucks. So, but, so here we are. It came down. This was another short-term trade. I think we put this one on February 23rd. So, it was more of a normal expiration date, but we are moving up again today. And so, especially given that we have 4 days to expiration, if this stays above this 325 level, and it only closed below that one day, we should be okay. Okay. So we're going to watch this. Okay. We're going to watch this one. Okay. So that's our short put verticals. And, the others are all looking, okay. J&J, we're up 45% on that. When it gets to 80, we'd be out on that. AMD hasn't filled yet, but we're waiting for that one to fill. Okay, so we've done AMD, we've done AVGO. Let's come and look at Target. Yeah, and Chris is saying, and you know what? Like, this is the counterpoint to it. If I only have $50 more to lose, and I have the opportunity to perhaps, eradicate or lessen this loss of $300, I think I'd rather take that. So yeah, I appreciate that line of thought. Yeah, and this is part of why we position size with short put verticals, so that we can afford to take that max loss. Okay, so we have a long call vertical on EOG, and energy stock. We're up 17% on that. Our target is to get out when we're up 50, so we don't have to do anything with that. But it's sitting there all lonely like. Could we? Oh my goodness, we've only got 5 minutes left. Where has this time gone? Yeah. So here's Target. It's just been rolling on up the hill. Like, when I looked at this, it was up a little bit on the day. It's now down 20 cents. But if we look at this, could we come in here and say, this 30-day moving average has been acting as a support level. Really since November of last year. It's come down and kissed it, kind of once, twice, 3 times a lady, 4 times. So could we come to this 115 and do a short put vertical, or do a long call vertical? Well, let's look at the short put vertical. 335 to 370. We've got 2,700 contracts. $1.50. So, you know, if we're looking at being out 30 days, it's 150 divided by 330, or divided by 350. So that's about a 33%, well, 42% return. So, you know, we're cool with that. Single order. I'll put in our exit on that. You know, at 30 cents, we want to buy it back when it's worth 30 cents. So that's the short put vertical. And I was going to do that as a long call vertical, but we'll look at this one again on Friday and just see if our frown has turned upside down, you know, and that this has in fact become a bullish candle, and seeing that this uptrend is continuing. You know, because if we look at that and we say, you know, could we do the 115 and the 120? We've got lots of contracts. Well, you know what? Let's just go for it. 258, we're going to put in a target at about 375, 380. And we're going to put that in our long call vertical group. Okay, so some of our trades haven't filled yet, but we will look at that. So what have we done today? Well, we've done a ton, actually. We reviewed our trade on Coca-Cola, the short put vertical that hit the target. We closed out the call that was part of our buy right on KMI. We rolled the call for our buy right covered call on Devon. And then we have got teed up a trade on AMD, a short put vertical on Target, and a long call vertical on Target, and also an iron condor on AVGO. So these are all currently waiting to fill, but after the class, I will make sure that those get filled today. I didn't see a survey in the chat, so you guys are off the hook on that. But if you would do me a favor, hit the like button. What that does is it helps move this up in the YouTube algorithm so more people can find this content. Also sounds like applause to Ben and I, as Cameron May would say. So we appreciate that. So Charles is saying, I'm wondering why you did both a short put vertical and a long call vertical. I did it so that we can compare and contrast them. And I originally did the short put vertical because it was pulling back, but looking like support would hold. And then I decided to take a walk on the wild side. And even though it now looks with the current candle like Target is pulling back a little bit today, that it looks from a technical perspective like that uptrend might continue. So we're going to compare and contrast those. So anyway, hit the like button. If you haven't subscribed to the channel yet, there is a button in the bottom right that gives you access to all the archives. And one of the archives I want to point out, just as we wrap things up, is a playlist called the Trade Management Mini Sessions. And in these mini sessions, I have a bunch of example trading plans. So I talked about, you know, is it meeting our requirement for a short put vertical? Here is where I've laid out the example trading plan we follow in this class. There's also an example trading plan for buy right covered calls. You know, there's about, I don't know, 8 or 10 example trading plans. And I will add more once I get some things sorted out with my new workstation here. So guys, thank you so much for joining me. Thanks to the guys behind the scenes, and thanks to Ben Watson for joining us today. Take care, everyone. Have a really awesome rest of your day. Bye for now.